Welcome to Global Investment Insights, a weekly podcast brought to you by ADCB Asset Management. My name is Kishore Muktinutalapati, Head of Investment Strategy. With an objective to empower you with investment insights, on this program we discuss various perspectives that are shaping the global investment landscape. We continue with our 2024 Annual Outlook series. After having discussed macroeconomic, asset allocation, and fixed income outlooks over the past couple of weeks, we now turn our focus to equities. History suggests more gains for equities during 2024 after the 20% return during 2023. Looking at the data since 1988, MSCI All Country World Index gained more than 20% in 8 different years if one excludes 2023. Keeping up the momentum, All Country World Index also posted smaller gains the following year, circa 4% on average over these 8 instances. In 2 of those, global equities posted losses of more than 10%, and these coincided with the dot-com bubble and the 2018 market sell-off triggered by the Fed raising interest rates, the Trump administration's tariffs driving uncertainty, big tech coming under scrutiny, and elevated equity valuations. In the other 6 instances, All Country World Index rose circa 10% on average after rising more than 20% the previous year. However, looking at all the 8 instances, the first half of the year that followed a year of 20% plus returns were largely flat to negative. This begins to suggest that in absence of a major recession, Fed's policy misstep and/or rise of political and geopolitical risks, global equities could post small but positive returns during 2024. Of course, there are certain aspects that warrant caution in the first half of the year. However, none of them would account for a fat left tail risk. Some of these risks are: equities look technically overbought, particularly US equities have rallied strongly through fourth quarter of last year and now look overbought on technical parameters. Just over the last 3 months, investor sentiment has gone from extremely bearish to extremely bullish. We use this as a contrarian indicator. Implied volatility is low, and this calls for a reality check of market complacency. Any pause in disinflation in the US could be treated by markets as a negative. Fourth quarter 2023 corporate earnings season is underway. We expect this season to be strong, but we're looking at lofty earnings expectations for this year, which stand at 11%. Any evidence that such lofty growth expectations might not be met will likely be encountered with elevated price volatility. Taking all these together, we expect the following. First, global equities post mid-single-digit gains over the next 12 months. However, the asset class is likely to experience a flat to weak first half of the year, followed by a strong recovery in the second half. While US stocks are rich in quality and our preferred way to play equities in the medium to long term, we're beginning to see better value in emerging and European equity markets tactically. We expect the market breadth to improve during 2024 from extremely narrow market leadership observed during 2023. Thematically, we prefer clean energy segments which have lagged the broader market in the last couple of years. By sector, we prefer healthcare during first half of the year, but would position into more cyclical industrial sector during the second half. Small caps could also benefit from the cyclical bounce in equities, which we expect to happen in the later part of the year. Thanks for listening. We hope you found this podcast useful. If you did, please do share this and other episodes with family, friends, and colleagues. For more information on our investment strategies, please reach out to your contact at ADCB. You can also log on to our website at www.adcbam.com. This is Kishore Muktinutalapati signing off.